Stocktwits Nation? It is Monday, July 28th. This is the Daily Rip Live. I am Katy Perry here with Shay Boloor. As always, Shay, what's up? How was the weekend?
Morning. Weekend's good. Much needed rest after the first week of earnings season. This week's gonna be even more of a polarizing, volatile one. So I definitely need that R&R, but I'm here. I'm ready.
Amazing. So do you have more media this week, or you did your blitz in New York and now you're taking it in this week?
I have a couple more media,
Okay.
which is great. It's turning into a weekly thing. It's
Uh,
just more for my office. It's a lot easier than having to go to a studio set, going in the
yes.
green room, and like standing and talk. I hate standing and talking. It's so difficult for me because what am I doing with my hands? I'm focusing my
Yeah.
hands and my words.
What do they tell you? You're supposed to pace? Or like I wouldn't even know what to do.
I don't know. Like I truly don't know. They
They
don't
just
tell you
put you
anything
out
first.
there.
Yeah, they just put you out there, and I do study tape. I do like the whole athlete thing. Like, oh, I should do this one better. So I improved. So it's a lot
I
easier
would
sitting in this
I
office
would
though.
freeze. I was told once I got feedback at work that I talk too much with my hands when I present. And I was like, well, I'm just gonna ignore that. But yeah, that's a lot. Well, I saw you everywhere last week, which is super exciting. And oh, yeah, there we go. They really don't make movies like that anymore. Did you see the new Happy Gilmore?
I did, and I'm insulted. It got a higher rating than Happy Gilmore 1,
It did?
which is yeah. The critics rated it higher than Happy
Oh,
Gilmore 1.
everything I saw on X, people were like, that sucked. And I'm like, what did you expect? It's Happy Gilmore too.
Well, I think it also illustrates how different the bar is now from critics than it was
Yeah.
back then. It's a lot easier to clear it apparently, but yeah, it was good. It was good for a sequel. Very cheesy at times.
Yeah.
I loved all the celebrities that just popped in. Everyone, like it feels like every couple minutes. Like, geez, why would Bunny agree to that
Yeah.
role? Eminem, why would he agree to being like the heckler and throwing in the water? Like it was
So
weird.
good. Yeah, I did see a clip with Eminem. I was like, I didn't watch the full thing yet, but I was like, oh, I got through a true crime thing I was watching, so I guess I'll pivot to that next. But later on the show today at 9:30, guys, we got Ryan Detrick coming. So he is the chief market strategist at Carson Group. He's got a lot of strong opinions and takes heading into this week, so we'll welcome him after the opening bell. But first, Shay, you mentioned earnings, and we have a lot happening this week. Tomorrow, we've got Boeing, PayPal, SoFi, Starbucks, Visa, United Healthcare, Spotify. Wednesday, we've got Meta, Microsoft, Ford, Robinhood. Thursday, Apple, Amazon, Roku, Strategy, Cloudflare, Reddit. Let's start with Cloudflare, Shy, because you talk about those guys a lot in your bucket. You excited for that one? Is there anything in particular you're looking forward to as they report out later this week?
Yeah, so I think that Cloudflare is still a severely under-discussed company in this like second stage of AI. Who's going to be the real winners? Everyone knows Palantir is a stage 2 AI winner, but Cloudflare is near an all-time high. It's being priced to perfection like Palantir is. I don't even know what their multiple is. I'm going to pull it up real quick. It's kind of something eye-watering where yeah, it's trading at 135 times EBITDA multiple, and that's substantial. But I think that I'm ignoring valuations right now because that's not really the weight of decision making in this current environment because the AI tsunami is coming, and right now you have to pick and choose who's not just going to survive but thrive. And Cloudflare absolutely is going to be one of those companies that will thrive. And a perfect example of that was essentially their latest addition to their AI suite, which is Workers AI. You guys hear me talking about Workers AI all the time, where it's becoming one of the fastest growing serverless ecosystems for inference at the edge. You guys also hear me talk about how inference is going to explode. You're seeing proof of it via NVIDIA on their networking revenue. You're seeing proof of it with Broadcom, which I call the Uncle Sam of AI because inference essentially is a tax you have on AI. The more you use it, the more you have to pay the toll for Uncle Sam. So I think that you're seeing AI gain a lot of momentum. You're going to see a lot of bullish notes and probably some commentary on that this week. But also, their more recent announcements was something called the crawler. Again, this happened a couple weeks ago. A lot of people didn't really talk about it because there's so many headlines this month. But they released something called a pay per crawl AI crawler metering product, that's a mouthful. But I do think that this is one in a product innovation in the AI era that shows how easy it is and how many levers that Cloudflare can pull in this environment where Cloudflare is essentially saying if LLMs are going to scrape and summarize the internet, which, spoiler alert, they are doing right now, the internet's going to have to send them a bill. And again, they're not going to be waiting for permission from Anthropic, Google, OpenAI, all these LLMs in order to do this. They're enforcing this on their own network because they have 20% of the internet running through them already. That's substantial. Again, this is why having a moat is so important, because in this new digital economy, you can leverage your moat into all these new product innovations. This is a classic example, and I do think this is where the second product released this past year that's clearly gained momentum and makes sense as a product fit in this agentic AI world we're about to enter. And Cloudflare is doing it with a founder-led CEO, Prince. A lot of people know Carp and Palantir. Prince is a wartime CEO as well. If you hear him talk, he's got some swagger. He's got some like edge, founder-led, and I just think that perfectly positioned to be a mega cap one day. So even though right now it's like stupid valuation, but it's based on traditional metrics right now and not the market share they're going to have in 5-10 years. And I think they're doing everything right, and stock price is just going up to the right as well.
I want to dig into a couple things you said because I think it illuminated maybe why more people aren't, like you said, they're not getting the headlines. It's just complicated stuff. When you were talking, I was like, oh, okay. And even you were breaking it down. But I think the first thing on, like, can we just quickly talk about the serverless GPUs, and is that an advantage in terms of scalability? Why is serverless GPU better or more efficient than the alternative?
It's all about being closer to the edge. So being closer to the user. I think latency is the kryptonite for agentic AI. It's all about the speed. Right now, we have not hit the ChatGPT moment for agentic AI, but when we do, latency will be the most important component of the calculus on what's going to be valuable in the new digital economy. So having inference as close to the edge, so by edge, I mean as close to the user, it doesn't have to be exactly to the server or CDN network. That's why it's so important, because it affects the speed of the data, and data is about to be moving from agent to agent super quick, super efficiently. So that, to answer that question, that's what that means. And also, like, you guys don't realize, like, crawlers, when you think about what makes Visa so powerful, it's that network. Like, every time you use them, they get a specific cut. That's what crawlers is doing for Cloudflare. They have 20% of the internet already. Sure, they're not going to make substantial amount of it, but if from due to all the LLMs out there. But every time someone's going to try to use the data, every time an LLM is going to try to use user data, they're going to have to go to the crawlers platform for 20% of it, and every single time Cloudflare gets a toll. That's the Visa of the new digital economy in this space. So that's an easy. Hopefully, that's an easier way to think about it than me getting too technical like I did before.
I think the crawler, I forgot that was pretty recent, but that's fascinating. From the revenue, obviously they get their cut, but also just a customer retention. I mean, all publishers now that are monetizing content are worried about what's happening. Google's the prime example given of AI summaries from articles. Obviously, a lot of websites make money on ads on their sites. If people aren't going to the site, the content's getting stripped, they're effed. And this is almost like a second reckoning. The publishers really hit a wall when Facebook got big and other social platforms took advertising revenue there. So they've already been beaten down. So in addition to just the revenue, it's if you saw the press release for this announcement, it was really effective how they did. They listed, like, I don't know, dozens and dozens of publishers who co-signed, and there was like dozens of quotes. Stocktwits was among the publishers quoted there, but it just showed you their ability to gather all of these industry players together and the influence they have. The 20% of all internet, I didn't know that stat until that release came out. So I think some of it is nuanced, but it is, I think what you're talking about is a future where data is almost currency on the internet, and they're positioning themselves to monetize part of that.
Yeah, I mean, you have to look into, like, if you want it's not a software company, but if you want a growth tech company, you have to, like, dig deeper into not just the traditional metrics. Like, if you look at the metrics right now, like, it's ugly. It's triple digit EBITDA multiple, triple digit free cash flow, PE. But for me, again, when you own 20% of the internet, that AI tsunami is not coming for that moat. It's actually going to be a tailwind. And they're when you have a great management like Matthew Prince, you feel confident they're going to capitalize on that moat in some way. And you're already seeing two major product releases in the past year alone to capitalize on that. Who knows in the next couple years? So that's why when I call them the control center for the modern internet, this is a perfect example why I've been saying that for the past year or two, and why I've been like building an overweight position at $70 when people were like, it's a 80 times EBITDA multiple. How are you doing that? I was like, I get it. It sucks. I don't like pressing the add button. But in this environment, I'm all about moats. This is one of the best monopolies in the market because a lot of these hyperscalers, you have to, again, ask yourself, what can't the hyperscalers do? Because SaaS is going to be a very icky term in the near term. A lot of these software companies will not want to be labeled as a SaaS company because SaaS will get disrupted by AI. So you're going to see a lot of companies who are clearly monetizing AI. ServiceNow is a perfect example. They are clearly monetizing AI. They are no longer a SaaS company. They grew up. So knowing that like AWS can't do what Cloudflare is doing, Azure is too tied up in their model warfare with OpenAI to kind of do much in that space. Google is actually the problem and what Cloudflare is trying to solve in a way, if you think about it. And Cloudflare is kind of sitting in the middle of the web. They're regulating access and they're monetizing intent. That monetizing intent part is very important, like you mentioned earlier, Katie. So I do think it gives developers tools to build the next version of the internet with observable serverless logic, and I think that's a democratization type of mentality, which again is gaining a lot more momentum these days.
Yeah, it's interesting. The SaaS used to be everything. Everyone wanted to be labeled SaaS. It was recurring revenue subscription. And right now, you've talked about this before, AI being more tied to usage, or that's more it's more appealing to investors. You mentioned ServiceNow. They reported last week. I think one of the things I caught from their earnings was they're apparently paying one of their cloud providers $1 billion.
Google.
Yeah. Okay. Google. So that goes back to kind of your initial point about, the second layer of AI and people like the cloud layer. Did you have any other takeaways from their earnings? It sounds like you're pretty on board with the direction they're headed.
Yeah, so we actually met with their management team last week, which is
Nice.
great.
That's founder led too, right?
Yeah, Bill. No, I don't think it is. I think I
Okay.
did meet the founder, but I think
Okay.
Bill was not the founder because I met
Okay.
the founder there. But either way, they know like this is a gloves off environment for them. Like they are
Yeah.
fully aware. SaaS, you can't be SaaS anymore, and not just that, you have to prove that you will be a major beneficiary of agentic AI, and I think that ServiceNow, the reason they're so impressive is because a lot of people don't realize they use it without knowing it. Like they have a
Mm.
very much a white label service. Like every company uses it, goes through them, and they could care less what model and chip you use. Their nirvana is having data talk, and then utilize and routing it towards the right models, orchestrating the workflow, and then creating an outcome of that workflow. That's why I do like to call them that the control tower of enterprise AI because they are kind of in the middle of everything, and that's a massive moat that won't get cannibalized from AI, the AI tsunami, and they're doing the right things right now ahead of that tsunami coming. They're going full speed ahead, and they're also kind of becoming competitors with some legacy players like Salesforce. Like a lot of the CRM now is going to be in ServiceNow, and they're becoming a competitor with Salesforce. And you're hearing Mark talk poorly about ServiceNow because he's fearful. Like he sees potential competition now. And what services? What they're a $200 billion company. What's Salesforce's market cap? I think they're almost. I don't want to. Yeah, 250. They're kind of peers now, almost in that element. So that shows like, oof, like one's positioned as AI might be a potential competitive headwind. ServiceNow is utilizing that, especially with their partnership that they have, and I do think that agentic AI is going to really benefit them as well because when right now everyone thinks about ServiceNow, you open a ticket and you talk to someone to help with this specific department. Now, eventually, the future is going to be you say what's the problem, and ServiceNow will have all the agents in each department talk to each other and just give you a solution right away.
Yeah.
That's massive. That's a huge. That solves a big bottleneck on a lot of these solutions that enterprises have, and I think they also have RaptorDB, which is their consumption angle on what the agentic AI world is going to be. And they realize like they have to pivot from the traditional licensing seat-based models into consumption, and RaptorDB is their Trojan horse for that. So I think they're really positioned well, and I think they've reacted. They went up after their last earnings print, which is a very tough thing to do this cycle, as you can tell from a lot of these names who've produced strong reports but red reactions.
I think what you described really illuminates sort of the movement SaaS to this other sort of data orchestration, because anyone who's sat in one of these jobs, half of a corporate job is getting information from a bunch of different points and weaving it together, and the time it takes to go to these different, it used to be humans, now it's databases, sources of information. The ability to bring that all together in an agentic way is really powerful, and it almost seems like Salesforce, that's like the old model of SaaS where it's like UX could be a moat or a differentiator, but if we're not actually doing, the orchestration ourselves, like how much does the UX wrapper matter? Or is it more about the engine behind it being more powerful? Is that's sort of what you're seeing with like a ServiceNow versus a Salesforce?
Yeah, so you nailed it, because I think that makeup used to deceive a lot of people. That's why I call the wrapper the UX wrapper. Nowadays, they're actually seeing what's underneath the makeup. Like you can't just fake it anymore, fake it to make it. You have to actually own the underlying data. That is one of the things that ServiceNow is actually actively working on, is that data component, because you have to own your own data. That's one of the reasons why I'm so bullish on Google and so bullish on Tesla, because they own the data. Tesla has so much real world data. Same with Google in a way with their workspace product suite. So like, I think that CRMs out there, they need to be fighting like their life depends on it, because their majority of them are just wrappers, the middleware, horizontal orchestration. That's a dangerous characteristic in this new world we're about to enter. It's not going to happen right away. I'm talking years from now, but when we're in this early innings of a super cycle like AI, that's so early and there's such a long runway where I believe is going to be indefinite demand. You cannot afford to pick the losers. You just can't. It's like you believed in the internet, but you didn't choose Google, Amazon, Microsoft, etc. You chose some .com company that had wolf.com or something that alternative, like it was like a rental. It really wasn't owning a life-changing company. Don't do that. You have to own the real winners with a real moat and let the market just carry it. That's so important. And yes, I get it. Valuation is always an important component of any decision making. I agree. Eventually, they have to have the fundamentals catch up to its valuation. But right now, we're so early that is taking a back seat. And if you find a company that's trading like, I don't know, a software growth tech company trading at under 30 times EBITDA, there's a reason for that. So you have to really feel comfortable that the market's seeing a disconnect, that you're clearly seeing that they're going to have a moat. And spoiler alert, 99% of the time, the market's right. So be cautious. Know that why you have your lens has a specific edge, because fundamentals by itself mean jack shit anymore these days. It's all about moat.
I think that's an important call, a critical moment for investors as we enter this or dive deeper into this AI cycle. You did mention Tesla. I want to talk about them because there's some news. They signed a $16.5 billion chip deal with Samsung. So that's to lock in supply for their next gen chips. Samsung's new Texas fab will make them, Musk saying the partnership could grow even larger. Shay, what's the deal with this one? I mean, Tesla has growing chip ambitions. How critical is this to their vertical integration strategy that you've talked about so frequently here on the show?
I mean, it's really important because you need think of Samsung as the AI factory. That's what Tesla's using them for. So my whole thing last week was all these media outlets was like, you need to own four things in the new digital economy: data, model, distribution, next gen, brain. In order to get all the hardware component of that formula, you need an AI factory. And right now, TSM is so backlogged that the speed that Elon wants the hardware is unattainable because TSMC is just way too, the demand is just way too high for the supply. So Samsung is a good-ish alternative. Like, I think that the reason I say good-ish, I'm kind of hard on them, is they have a TSMC problem. Samsung really hasn't been the poster child for foundry reliability last few years. They've been trailing TSM in yields, clearly customer and client trust, and their integration to their ecosystem has been very messy. But with Tesla trying to anchor its 3NM roadmap in Texas with Samsung, I do think it helps Samsung get some validation at the highest level. Whether they succeed or not, I do think the one constant is, though, and the read through of this headline isn't Tesla or Samsung, it's ASML. If you look up ASML, I actually didn't look at their pre-market action, but I think they're probably green. Yeah, that's the read through. So the reason why ASML is such a read through is, what do you need for the tools in order to get this transition to work? And what you need is the EUV machines that ASML offers, and they own 100% of that market. So when you need advanced logic, which is, again, when you have a 3NM deal like Samsung, that essentially means advanced logic, you're going to need it's going to cause rising demand for the EUV and high NA tools, and ASML is the only supplier in the world that offers that. So when there's a $17 billion deal announced, I don't know how many years is over, but I'm sure it's over a decent amount of years. Doesn't matter. That's going to be an additional incremental demand for ASML's chips. And it's also, ASML will benefit so substantially if there's more players in their arena than TSMC. Like, that's why if Intel can solve 14A, which is TAN's North Star in 2028, that's going to be a major tailwind for ASML as well. And now if Samsung actually starts catching up, not catching up to TSM, but at least gains momentum, that's a huge tailwind for ASML as well. So I think ASML is a name that hasn't really caught a bid in the AI trade. It's under 30 times earnings, but they are the AI kingmaker, and you need their EUV tools for the latest and greatest. And I'm not surprised to see them up 4% pre-market from that news.
Yeah, and so in layman's terms, ASML makes the machines that make the semiconductors.
Yeah, exactly.
Okay.
So when you think of monopolies, it's AI Factory and TSM, and then ASML, which essentially is the EUV machine. It's the kingmaker for TSM to do what they do. And then NVIDIA just takes it from there and does their whole spiel, their whole ecosystem.
Interesting. Wild stuff. Let's quickly, before opening bell comes and we bring on Ryan, I want to talk about some of the fintech earnings coming out this week. SoFi, Robinhood, we've talked about them a bunch. PayPal, we don't talk about as much, but they're also reporting. SoFi has had a pretty good month. I didn't check on them last week, but 2 weeks ago they had some product announcements. They breached $20 a share. Robinhood obviously continued sustained momentum after their big fancy event in Cannes. What are you looking out for with these two in particular?
Expectations are very high entering both of their prints. It's been a minute since SoFi has caught this kind of bid entering an earnings report. Usually it's the opposite. They report really strong numbers and fade that move. Curious on what the reaction is going to be tomorrow morning. But for SoFi specifically, I want to see how their products above 1 million are gaining momentum, what the membership growth above 700K is, because that would reinforce their flywheel is intact. I want to see their net margins like be above 6%. Also some color on any new Galileo partnerships, because that was supposed to be their AWS of the fintech ecosystem, and that's really fizzled out a bit. So I think for SoFi, it's going to be really important to see their continued outperformance in their financial service segments, because that is their high margin fee-based engine, which really proves that SoFi isn't just a lending machine, and that's why majority of the revenue isn't actually in student loans anymore is because of that financial services segment. So that's a really important um, metric to keep track on tomorrow. For Robinhood, I mean, the expectations sky high. You talk valuation, it's got a premium now, and that's really rare as a fintech label. So I think for Robinhood to prove that they deserve to trade above $100, they need to continue showing that monetization per user is trending up, and not just in the brokerage trading. It's like you have to track it via subscriptions and retirement flows. I think you have to see that what the gold growth is going to be. I want to say it's closer to 4 million they're trying to aim at. I also want to see if the AUM in the retirement space is above 15 million. But I also think that the Bitstamp is the first time this like they're fully integrated. So I want to see how that has correlated in the crypto volume accelerating, or if there's any kind of cross pollination for people who have been using Robinhood for a while and their international crypto base. Like that's an interesting area. But either way, I do think that in this cycle so far, tech earnings, the names have ran up, have had red reactions as profit taking on really strong prints. Curious to see if that's going to be like in the fintech space. But like, I don't know, look at this price action for Robinhood. Like it went from $35 a couple months ago. Now it's above 105. You got to zoom out and see like what's being priced in or not. But I'm rooting for, I can't believe it's about to be $100 billion company too, which is nuts.
Yeah, I mean, the gold card, I think, is something to watch. Those have been shipping out. I keep seeing people sharing those out. And I'm also curious about like international, because they did make that big splash internationally with the tokenization, seemingly potentially see some user growth there. There's our opening bell. SoFi, before we bring our guest in, I have one question for you on SoFi, Shy, because I always forget, we always talk about them, people looking at them like, okay, I missed Robinhood. You talk about that, we've had them bookmarked, and then you missed the wave that you wanted to get in on, so people look for the next thing. SoFi doesn't actually have, I don't believe their crypto product's live yet, correct? Like, I think they're like bringing it.
I think they announced it.
They announced
recently.
it. So like, that's interesting to me because all of this momentum around SoFi, that's not even with that whole aspect of their business being live. So I don't know. I think about that a lot because I'm like, okay, that's not even a piece yet, and it's going to be. And it'll be interesting to see because they do have a slightly different user profile because they have a lot of more traditional financial products. And to your point, you want to see like what's the AUM per user, who are they bringing in? But I always forget that that's not actually, you can't even actually trade crypto right now on SoFi. And when that happens, how is that going to impact things for them? So we shall see. Let's bring in Ryan. Ryan Detrick is in the house. OG, and look at this setup.
Hello, guys.
Hi, Ryan.
How we doing? I made it.
You made it. How are you?
Doing well. Let me push this back some. I never know how close it's going to look when I get here. So there we go.
Honestly, this is a great shot.
All right. Well, thank you.
You're putting us to shame. I want logos behind me.
Where
are you calling in from?
So I'm based in Cincinnati, Ohio.
Nice.
I work for Carson Group. We're a $42 billion RIA that's based in Omaha. But,
awesome.
We're in like 40, it depends what time it is, but we're signing some other ones. I think we're in 42 or 43 states. We've got some new financial advisors signing along with us very soon. So I'm honored to get to join you and talk about some stuff this morning, though. Thank you.
We're excited to have you here, and we have a whole gamut of things we want to ask you. You bring up Cincy. I had some college friends from Cincy, and they'd always talk about the spaghetti plate thing.
Oh, that would be our
Edwards?
Yeah, well, Skyline Chili three-way.
Chili.
That's what it would be.
Okay.
Yeah, it's weird unless you're from here. You take spaghetti and you put the chili on top and cheese on top, and I guess it sounds gross. If you eat it your whole life, it's actually pretty good.
I'm from Western New York. We have like garbage plates, which pretty much is what it is.
I'm from LA, and that's a crazy concept. We just called out.
That is like no one in LA would ever go for that.
That's probably
true. That's what makes it great. I said Edwards because there's a diner in New York City that does that. They have like a Cincy night. So,
got it. Oh yeah, well, that makes sense. Okay, cool.
Yeah, well, amazing. Glad to have some Midwest representation up in here today. Let's get right into it. Some of we were going through some of the things you've been talking about already and want to dig deeper. Let's start with just the state of the markets. S&P up 8.6% year to date.
Yeah. So
what happens next?
What? Anything easier to start with? I'm teasing.
Tell us exactly what the future holds.
Yeah. So cool. So there's my chart. That's awesome. So I'm glad you have that. So what's so unique about markets, right? We know the S&P is up about 9% on average per year, but I joke there's no such thing as average when it comes to investing. Because 22 times the stock market gained 20%, 21 times it's been down. So the odds of a 20% gain for the year are higher than a down year. I think that's kind of surprising to most people when the first time they hear that. But the other thing that's shocking is what the chart shares. Only 4 times, going back 75 years, have we seen a quote-unquote average year up between 8 and 10%. So again, we know bigger swings, bigger moves are more normal. So the thing we're really stressing, right, to our financial advisors and their clients is, will we finish flat right here for the year? Maybe. Probably not, though. The odds continue to favor. We'll get more in the weeds of, we've been bullish for a while. We still are. The odds that we're going to continue to have a rally, because you don't usually have an average year. We think we're going to have continued strong gains the second half of this year. That's one. That's kind of one example. What other charts did you swipe from me there? This is exciting.
Oh yeah, we're everywhere. We got eyes on you,
That's
Ryan.
right. Good.
I did see our producer also called out that the day before the lows in April, you tweeted or put out there, you're like, we're going to end up for the year. What was going through your head when you said that? Why did you make that call?
I just wanted to make the Bears mad, I guess. I mean, it's very easy to look back and say, oh, yeah, the market's going to rally. I mean, when we were down 15% for the year on April 8th, that felt pretty bad. Right. Now, one of the things we were stressing after back-to-back 20% years, we were on record the first half of the year to probably have between a 12 to 15% peak to trough correction, because we'd gone 2 years without something like that. That's not like rocket science, but it just made sense to us. Early in a post-election year, you tend to get volatility, weakness. First quarter is the worst quarter of the last 20 years. Oh, by the way, after a 20% gain, first quarter is usually pretty weak. So it made sense. And then, of course, what happened Liberation Day, the worst 2-day drop we've seen in a long, long time, down 10.5%. And then I shared this. I did some numbers, like literally, again, this is the day before the low, said it's possible to come back to positive. It's so fascinating. I call this like the beach ball effect. You take a ball under the water a long way, and then you let it go. Once it gets going, it goes a lot further. As everyone can see there, the 4 times actually went back to positive when you're down at least 15% for the year at some point during the year. Every one of those years finished up double digits, right? And some of them even by a wider margin. So this is something that we were sharing a lot. And if everybody's thinking alike, somebody isn't thinking. General Patton. I had so many people reaching out to me the first week of April that knew what I did, but honestly don't pay too much attention to the market. And they're telling me how bad everything is going to be. They're telling me how the trade's going to do this, inflation going to do that. These people don't know what they're talking about. I'm like, there is so much negativity priced in. If we get any good news at all, and the next day was a 9.5% rally in the S&P with 99% of all the volume up and like 99% of all the stocks up. And I looked at that day and said, this is the low. Like that's when lows happen, when you have that strength. But what we really wanted to see was one more super strong up day. On April 21st, we had that within a 2-week period, 2 super strong up days. And we were on record then saying that's it, the lows are in. I don't know the stats and figures, we can get into it. But we've been overweight equities this whole year. Honestly, Carson made a name for ourselves at the start of 23. We said there'd be no recession, no bear market. No, it's obvious now. But that was hated. Like I wasn't even allowed to go on certain TV shows because we were bullish back then, okay? I mean, that's how bad it was. But that's okay. We followed a process, stuck with it. What we've done this year, last comment, we were very overweight U.S. the last couple of years. We have gone more into international. We did that back in like March, and I know Europe's done very well. We think it makes sense from a diversified portfolio point of view. There are a lot more opportunities now than there maybe were before, but this is still a global bull market, and this is still a lot of reasons to think it's not over yet. It's kind of where I'd put it.
Yeah. Ryan, when you talk about the beach ball analogy, I hope I'm not messing up your analogy, but I'm curious when I'm looking at that chart in the recent years, only since 2020 has there been this mass wave of retail investors connecting online using these platforms. How much of the kind of bounce back and the recovery do you attribute to retail investors staying in it, putting more money in, and then having, the other guys follow them?
Yeah, that's a great point because it's very rare, I think, to see what we're seeing, but we are seeing it. And like we say, congratulations to retail because they actually have done quite well aggressively buying the April lows. When we look at the data from the CFTC, and I'm sure you talk about this with other guests, the hedge funds and large institutions are betting against the market the most they bet against it in several months. It's like they're getting a fear of heights, but yet the retail crowd isn't. Now, I know the meme stocks are starting to go crazy again, and you wonder, well, is that a peak sign? We saw that in late 21 when the SPACs were doing well, and then everything kind of came crashing down or in a big way in 22. We'd say not. That's a potential near-term worry, but just literally like this weekend, Gallup poll had a poll come out. 6 out of 10 people they asked in this recent poll said more volatility, more trouble is coming. Okay. Now, again, yes, it's skewed by politics, but the reality is, I think it's 4 weeks in a row now. We've seen bulls go down in the AAII poll, that NAAIM active managers has gone down again. You've got 5 days last week, 5 days in a row of new all-time highs every single day of the week. You got to go back to November 21. We've seen that. So it's really fascinating to us. The market's strong. It's a broad-based rally, yet overall market sentiment, it sure doesn't feel too excited to me. And as someone who travels to, I'll be in Chicago tomorrow. I travel all over the place. I do stuff. When I get to talk to clients, I never get asked, hey, this is really good. How high can this go? Right? It's always how bad it's going to be. And from that contrarian point of view, I think with the 7.2 trillion, I think is what it is, maybe 7.2 or 7.4 trillion dollars in money markets with all the big institutions that continue to bet against this rally likely will continue to go higher in our opinion.
Really wild stuff. And I think there's also been commentary just on the herd mentality, usually associated with retail. Now that's going over to institutional. Shay, I know you're tracking a lot of companies and earnings this week. Anything in particular you want to get Ryan's take on as we have time with him here today?
I mean, listen, AI is still the main event. You clearly saw it last week. Google Cloud was a major inflection point in their business. I think there's going to be a lot of read-throughs on what Azure is going to do. I think it's 35% growth potentially on that segment. AWS is the king of cloud computing, and they have a law of large number base, so it's a little less year-over-year growth, but you're going to see cloud just continue to its momentum, which, again, is going to re-accelerate the theme of AI as the main event. So, like, when retail bought that dip that Ryan's talking about, is partly VIX is at a 50 handle. My style is like, when the VIX is at a 50 handle, you freaking buy because there's a lot of fear priced in. And historically, that's probably proven accurately. I'm sure Ryan can tell that information. I can, but I think that's part A. Part B is knowing that you can't just flip a switch off of AI infra spend. Like, that's just not how it works. So even this terror for that we're having and the paralysis in business spending, it was not going to affect AI infrastructure. And you're going to continue seeing dollars flow in there for years to come. So question for you though, Ryan, right now, daily charts are pretty overextended. I think SPY's at 75. For me, I think a new variable has to hit the market for there to be any kind of pullback. And right now, I just only see earnings being the catalyst in near term. Maybe some seasonality weakness, profit taking in August ahead of September. But for you, what's your kind of take on us being at a 75 plus in daily RSI? Do we consolidate here, or is there going to be some kind of pullback towards the 21-week EMA, for example, which is the sweet spot for me?
Sure. I think more just consolidation makes sense, and we've kind of been seeing that. I mean, we've gone well over a month without so much as a 1% drop or gain on the S&P. You got to go back before Flag Day, which I know no one really pays attention to Flag Day. I get it. That was the middle of June, the last time we had a 1% down day. So we've kind of had this slow and steady, don't short a dull market type of mentality. A couple of things came into my head as you were talking there, though. Earnings obviously have been strong. Net revisions have been very high. If you look at forward S&P 500 guidance or the next 12 months, that's an all-time high. Also, forward 12-month profit margins are at a new cycle high. We call those the dual tailwinds to a bull market. Those are positive. But you mentioned seasonality. A couple of things I want to point out here. August, for whatever reason, is this 1 month where stuff comes out of the blue. Let's not forget what happened last year, right? We had the yen carry trade unwind. No one was talking about yen carry trade unwinds until one Sunday night when we all went to sleep knowing Japan was having its worst day since 87. U.S. market was lit up for 3 straight days, and everything kind of calmed down and went away. And August has had these events before. In fact, if you look at post-election year, August is like the 11th, or how want to word this, the second worst month. Okay, only February is worse, but here's what gets really interesting. Since Eisenhower in 53, a post-election year, where we are now, with a second-term president, where we are now, has never been higher. August never higher. I think it's down like 5 or 6 times. So again, maybe it's small sample size. I get it all, but those are some things that we're looking at. I think in normal consolidation, normal after the rally we've had, 28% rally in about 3 months or so. Those are all things we're watching and thinking about. But the reality again is, well, that's why you diversify, right? I mean, I look at gold. Gold went up a lot. It went sideways for a while. It looks like it would start going up again. The dollar obviously looks like it's still weak. So again, we've got a little bit of bond exposure. We still think stocks do better than bonds. We have the international exposure. There's some other areas. Maybe the market, the S&P 500 takes a break. That's okay. But there are other areas that hopefully do well, and that's how we still are looking at managing the billions of dollars we manage.
What's your take on the whack-a-mole market right now, where you're seeing, by that I mean retail's looking for what's next, what's going to pop up and ride that. So usually that's a precursor on near-term pullback. I know that's the FUD is generated right now. What's your take on like you seeing like the open door move, for example, and Kohl's, for example? Like, does that feel like frothiness that something needs to get like priced? Do you need to get priced out a bit, or is this like name of the game?
I think it's more name of the game. I think it's just kind of where we are. I mean, I'm aware 21 what happened with AMC and GameStop. It's showing some potential froth, but again, then I can just as easily as I cited a little bit ago show there's really not over the top optimism at all. It's like these small little cohorts that are doing things. I think at the end of the day, the reality is we have new highs in advanced decline lines. We have new highs around the globe. I don't think there's over the top optimism by any means. We have obviously a market an economy that's slowing down a little bit. I don't think slowing down means recession, though. And what was being priced in this time, I don't know, 11, 12 weeks ago was a full-blown recession. And the reality is, yes, these higher interest rates. I mean, the trade war is over, by the way. I mean, the trade war is over. Like, we can talk about all you want, but the reality, that's over. What did we get out of the trade war? Well, we got some higher tariffs. Our country's going to probably bring in $2 trillion the next 10 years. We also got higher interest rates out of it, right? You got to finance this deficit somehow. So we have higher interest rates. That's what's put the Fed in a tough spot. The Fed, of course, has a meeting on Wednesday. One interesting stat, they're probably going to have 2 dissenters. I think it's Bowman and Waller are probably going to dissent to the idea that the Fed's going to stay pat. They're saying we should cut. December of 93 was the last time we saw 2 dissensions, okay, by 2 Fed governors. You got to go a long time for that. Usually they agree. Maybe they're not. So there's a lot of pressure on Powell. We're the opinion they probably should be cutting. Inflation doesn't seem like a problem, but those are some of the big concepts we're watching. And actually, you can put that chart back up. That's the one that I just shared from Gallup poll that it shows, again, just kind of what's the average person feel? When you can look at those numbers, they feel like the worst is still coming. They feel like there's more volatility coming. 6 out of 10 people think there's still more volatility and bad times coming. I mean, to me, that doesn't feel frothy when I look at overall market sentiment. Again, that's a Gallup poll that just came out.
And the Gallup poll, Ryan, is this investors or total population?
Total population, which I kind of like more because investors maybe are a little bit smarter. And you can see here, that's kind of, it is political. I mean, 88% of Democrats think things are going to get worse. I mean, I don't know. It is what it is, right? I mean, now listen, 4 years ago, it might have been the opposite. But the reality is these are just kind of average people, which I kind of like because, again, that's what they're hearing on TV or what they're seeing. And literally people think the market's volatile. Okay, we haven't had a 1% move up or down for over a month. All right. I mean, that is like one of the longest streaks we've seen in a long time. Market's not volatile. Okay. Yet, for whatever reason, the average person thinks it is. And I get it because all the crazy headlines. But, for investors and people watching this show, well, our job is to create alpha. Our job is to make money. With people still doubting this bull market, I think that means it's probably going to continue to work its way higher.
I also think that Ryan brought up a really interesting point about those 2 Fed chairs. I think you're going to see a lot of positioning on individuals who want to become the next Fed chair. And how do you become in favor of Trump? Bucking whatever Powell's doing and saying rate cuts, rate cuts, rate cuts.
Yeah.
I think you're going to see more Fed chairs kind of follow that suit if they actually want to put their hat in the ring. And I think that we should have cut rates already. I do think it's become a little more political than it should have
Yep.
been. Whether Powell admits it or not, I don't know if we're going to get 2 rate cuts this year. And that's a potential heartburn that I think maybe the market's not pricing in. If September's supposed to be a slam dunk, what if it isn't? I think there's maybe 4 more meetings rest of the year, maybe 5. So I think there's like 2 of those 4 or 5 meetings, they're going to have to cut rates. And the data isn't screaming to Powell like he's forced in the corner. And I think that is a little worry that the market maybe needs to not be so offsides on assuming it's going to be the case.
Yeah, I mean, we all saw the video on Friday of
so awkward. Oh my
yeah,
god.
it was like straight out the movie, the show The Office. I mean, so Powell's kind of digging his heels in. Here's what's fascinating. I mean, we know his term is up, 7 months, give or take, whenever next May is. But he can stay on, right? He can stay on. He's just not going to lead the thing. He's just going to be one of the generals there. So I think he probably does just to spite President Trump at this point. But it's a great point that who gets to pick the next Fed chairperson? Well, the president gets to pick that. So yes, Waller and different people are out there trying to say, look how dovish I am, maybe for the next job. But again, it's a very unique situation. But I guess high level, we look at inflation. The recent CPI data we got, a week or 2 ago. Furniture is costing more, toys are costing more, sporting goods are costing more. That's the stuff you'd expect to see costing more. But shelter and rents and owner rent equivalent, OER, are 40% of core CPI. Keep this real simple. The real-time data told us for a while that rent prices are negative year over year. Places like Apartment List and Zillow, the government's data for a while was between 4 and 5%. Yeah. That part's finally starting to crack. So you got parts of inflation going up, but you got other parts that are really starting to improve, hopefully potentially offsetting those. And again, with the trade war, the big question, this is something Waller just said recently, are tariffs a tax or are tariffs inflationary? He thinks it's a one-time tax, not necessarily higher prices down the line. We tend to agree with that. So maybe you get a pop in pricing here or there, but to say you're going to consistently have higher prices because of tariffs, we're not so sure about that. And I think the market literally hitting all-time highs feels like every single day. The market's the one betting or smarter than all of us, and it's kind of saying also the trade war's over and it's not worried about inflation.
Well, I think also Ryan highlighted, first off, trueflation's been a one handle for quite a while. And so I think it's been very normal. The bottleneck areas, guess what physical AI is going to disrupt that's going to cause deflationary environment for those areas? Furniture, these appliances, like automating warehouses and cost consumers to have to pay less because to create those products is going to be cheaper for the enterprises, etc. So I think that knowing that how deflationary AI is going to be, that's why I'm erring on the side of be a little more aggressive on rate cuts because you don't want to break something for having something higher for longer, knowing that physical AI is going to cause a deflationary environment. So I think that all these bottlenecks that we're seeing right now from the tariff war, even if it's one-off, maybe it's a couple, I don't know, maybe it's 1 or 2 more years of higher prices. Just if you're in part of that camp, it's temporary. There's going to be a deflationary environment.
And I'll just say this. I mean, you talk about like what could mess up the apple cart. I mean, it is a Fed policy mistake, and we all know President Trump calls him Mr. Too Late. But the reality is in 2021, things are going crazy. SPACs are going crazy. Everybody's making a ton of money. The Fed should have started hiking back then. We saw clear signs they should have. They didn't. Terrible war started in March 2022, way behind the curve, most aggressive Fed hiking schedule we've seen in a generation. And now on the other side, we've been I've got a podcast, Facts versus Feelings. We've been very public on there all year back in January saying the Fed should be cutting now. And we get it. They didn't want to because they knew President Trump won. They knew these tariffs were coming. They knew potentially higher prices were coming. But it is Jerome Powell's legacy. Okay, I mean, like he's done in May. Okay, at least done being in charge in May. So again, he doesn't want to be the guy who kind of was a little late the first time with inflation, and then he starts cutting as massive inflation comes in due to potential tariffs. Again, different Fed members have different opinions on that, and we would as well. But the reality is they probably are late again, or he's probably late again.
Ryan, looking at Powell's term today, I'm curious, like what grade do you give him overall?
Yeah, I'd say C+. I mean, that's being nice. I mean, I'm not. I guess if he cuts in September, maybe he'll go a little bit better because we think he should be. But
solid B student, or
does he have room to get up? Yeah, I'm trying to think, but yeah, I'm not too. not overly thrilled with it. I mean, it is what it is. But I mean, listen, he's in a tough spot, but it's incredible to me how much data the Fed has, and you kind of look back like, wow, late 21, wasn't it obvious? Like a guy like Dave Portnoy sees a deer out his window and says, I'm going to buy the stock deer, and he does, and it makes money. That was a sign that things were a little crazy back then. Everybody's making money, government giving people money, all this and that. Maybe they should have realized it after the fact, or even in the middle of the fact. But it is what it is. It didn't happen. But I always say, I'll kind of wrap it up with this. I say there's two things I really like to follow: advanced decline lines, and what are the credit markets telling us? Well, advanced decline lines across the board are hitting new all-time highs. That tells you the market has breadth, right? One of the big media reached out to me last week. Oh, market breadth is weak. Market breadth is not weak. Literally, the S&P 500 equal weight hit an all-time high last week. Okay, that's not weak market breadth. That is participation. All 11 sectors up on the year. That is participation. And the other thing on credit markets, I mean, I look at credit spreads all the time. I look at high yield spreads, investment corporate spreads. How are junk bonds doing? Just fine. I mean, even in April, when the market was literally in a bear market and collapsing, credit markets were hanging in there really, really well. Credit spreads did not blow out nearly as much as it did in 2021. Those are little clues to us, like on April 8th I was talking about, where I said, listen, I think we'd come back to positive. Those are the things we were seeing. Right now, new highs on advanced decline lines and very little stress in credit markets. You can always have some indigestion, and maybe it's something we didn't even see coming because it's August. That tends to happen, but I think it'll be contained between 4 to 6% drop real quick, and then we'll just keep on trucking higher.
Got one more for you before we let you go, Ryan. You said trade war is over. Obviously, we had a lot of things being tied up. The EU announcement made yesterday. China getting kicked down the road.
Yep.
What is the impact of all of these other deals kind of wrapping up ahead of that one? Is that part of why you feel like it's over already, because things are kind of moving into place and they're just going to be the last in the order?
Yep, we do. We think so. I mean, UK was obviously first. You've got Indonesia, Vietnam. Obviously, Japan was a big deal. I mean, what happened to Japan last week? Nikkei goes up 5.5%, hits an all-time high on that trade deal. US rallies as well. Obviously, with the EU, some of the fine print is still, I guess the ink needs to dry a little bit. But the reality is, I don't think anyone wants to go back to what happened in April, including President Trump. They're going to tout it that, listen, EU is going to buy 600 million here. Japan's going to buy 550 billion here. 15% tariffs seem to be that number. At the start of this whole thing, 15% tariff sounded like a lot, and then the effective tariff rate after Liberation Day was 25%, and now the market's actually relieved with 15% tariffs. Kind of amazing how that happens. But China, they're kicking the can, I guess. I guess they're meeting right now at the same time, but they're trying to work out some deals. But I think it's good to see, at least with most of our major trading partners, that things are pretty much wrapping up. I think everybody wants to get past that. They knew when President Trump won, this is going to be the case. When President Trump won, there were three things supposed to happen, right? Deregulation, lower taxes, those are the two positives, and then tariffs, essentially negative. Well, it happened not necessarily in that order. It was the exact opposite order, with tariffs first, but now that's out of the way, and now hopefully with deregulation and the one big beautiful bill, listen, there's issues with that because we're going to continue to have higher deficits, but there are some potential positives. Spending and higher deficits as a percent of GDP tends to what? It tends to lead to higher corporate profits and stronger stock market. So that's, again, all things that are in there and still more positive than negatives in our opinion.
All right, Ryan, this was awesome. You got to come back soon. I know you have a bunch of other hits to do today, but we appreciate you so much, and hopefully you'll come back soon. And we will be back. Shine, I'll be back tomorrow, Tuesday, with Jake Wu, as always, on Tuesdays. Tune in at 9 a.m. Eastern, and we'll see you guys bright and early tomorrow. Thanks, everyone.
Thank you.